Hey, what's going on, guys? This is Blood Phantom 81, aka Alex, and today I'm going to be walking through my growth portfolio that I've had ever since November 26th, 2018. So I do plan on growing this portfolio quicker than my other portfolios, especially in terms of capital appreciation, and I plan on doing that by investing in growth stocks. So the way I determined these growth stocks is by looking at their past performance. So while I do understand that past performance does not dictate future performance, I think it's fair to say that in an example of, let's say, Netflix versus Procter and Gamble, if you're bullish on both of them in the future, it's probable to say that Netflix will outpace Procter and Gamble. At least if you were going to take a bet, that's kind of the approach that you would go. So I used that same logic and thought about what were some of the strongest trends when looking backwards, and how did these stocks deal with certain volatility to make my predictions for how well I think they could deal with volatility in the future. First, I'm just going to do a brief overview of this. So this is about, I don't know, maybe like 20-ish holdings or maybe less than 20 holdings at this point. I've kept it very tight and I've definitely narrowed it a lot. I did remove Netflix from this portfolio, which I'm kind of second guessing, but other than that, I'm pretty confident and comfortable with the stocks that I have here. So let's just go through them one by one. First stock on the list is Visa. Now this one does pay a dividend yield, which I like. This one pays a dividend yield of under 1%. So it's not very much, but still enough for me to feel happy about it. Visa is actually my largest holding. So this one is about 11%, while the rest of them are 9% at most. So let's talk about why I picked Visa to be the number one. So I knew that I was going to have a lot of tech stocks here. I mean, the next 5 or 6 are all tech stocks. So I didn't want my largest holding to be a tech stock, and I wanted some kind of diversification at least. So I liked Visa for that. When we look at Visa from a long-term perspective, however, it is practically the poster child of what I look for from a technical analysis perspective. So both of these lines, let me go ahead and adjust this one to the 100-week moving average. So the 100 and 200 week moving averages I consider to be long-term trend lines in areas of support. And so we can assess how strong a trend is based on how price action revolves around these stocks. So ever since the IPO here in 2011, the 100 moving average existed here in around 2010. And since 2010, Visa's price action has never even dipped below the 100-week moving average. So sometimes the 200-week serves as support, and that's an ideal place to bounce off of, but we haven't even retested the 200-week moving average. That's how strong Visa has been. And so just to be clear, the 100-week is the cyan line, and the 200-week is the magenta line. So as you guys can see, this cyan line has acted as support numerous times here in 2014 and 2015 and even 2016, and here once again in 2018, not too long ago. So I love that about Visa. Next stock I want to talk about, which is my second largest holding, is Google. So why did I make Google my second largest holding? After all, they don't pay dividend yield. It's basically this. I firmly believe that Google will not go out of style. They are just way too ingrained in all of our daily lives. And obviously, once again, the trend is pretty strong. So it's not the poster child that Visa is. Here in 2011, we did go briefly below the 200-week moving average, and then here in 2014, we did go briefly below the 100-week moving average. But other than that, I like where this is headed. Very, very strong trend. We recently found support here around the 100-week moving average. We closed above it for a couple weeks, but quickly recovered. So all systems are set to go for Google, and I definitely like this one a lot. Next stock on the list is Amazon. So pretty similar to Google in that I feel like Amazon won't go out of style. I feel the same way for Amazon. However, it is a little bit more volatile, so that's something to keep in mind. I'm not a huge fan of volatility, but Amazon does offer more upside than Google, in my opinion. So the trend looks a little bit stronger than Google's. The one time we did retest the 200-week moving average was here around 2014, but other than that, we've remained very strong, never dipping below either of these moving averages except here in 2014. And then here in 2018, we bounced off of the 100-week moving average, a very ideal place to buy. I did swing trade this one on Robinhood, but I plan on holding this M1 Finance portfolio for a very, very long time. Next stock on the list is Apple. So Apple has actually encountered a lot of resistance recently. So it's around January 15 as I film this video. We're showing support here at the 200-week moving average, but it's definitely a little bit more vulnerable than a lot of these other stocks compared to something like Amazon, which has been bouncing a lot over the past few weeks. Apple has kind of stayed the same, and it currently hovers around the 140, 150 price range. I did go ahead and purchase a lot of Apple recently on my Robinhood account. But what Apple is going through is nothing new for me, in my honest opinion. So every 3 or 4 years, Apple experiences a lot of volatility where they'll come down and they'll retest the 200-week moving average. It happened here in 2012, happened here in 2015, and it's happening here again in 2018 and 2019. So I'm sure that for these other time periods, there were some really good reasons for why Apple was dropping. Currently, the reason right now is, well, a couple things. I think Apple didn't want to disclose their iPhone sales. And number two, I think people are unsure of how tariffs are going to affect iPhone sales, and the economy in China might be slowing down. So that's a few reasons. Look, there's always going to be reasons for why you shouldn't buy a stock. But when you zoom out and you look at it from an unbiased perspective, Apple is still above the 200-week moving average. If we start to creep below this line, then I might get a little bit more cautious, because we haven't done that. Even in times of the 2008 recession, very briefly got below the 200-week moving average, as you guys can see. But for the most part, this magenta line acts as a long-term average. So Apple I like a lot. Next stock on the list is Microsoft. So Microsoft does pay a dividend yield of about 1.8%, which is more than twice Visa's dividend yield. And Microsoft is very anti-volatility. Pretty similar to Visa, the trend is very strong. So from this period of 2016 all the way up to 2018, we didn't even come close to retesting the 100-week moving average. And even here in 2018, when it was a very volatile period for the stock market, we didn't come that close to retesting this moving average. And it looks kind of like we've bottomed already. So Microsoft in recent times has been very strong, but almost quite defensive. So same thing with Visa. Since 2011, we've come back and we've only dipped below the 100-week moving average here in August 2015. But other than that, we've remained above the 200-week moving average and both trend lines. So Microsoft I definitely like a lot. The next stock on the list I think deserves a lot of introduction because it's not a stock, it's an ETF. And I do not recommend investing in this one. This is a triple leverage ETF by Direxion. And what it means is that the index that this is following, which I believe is XLK, or the technology sector of the S&P 500, for every daily 1% that the XLK moves, TECL will move 3%. So I do not recommend this one at all. I'm not saying to buy this one. Personally, myself, I'm okay with the risk. I'm okay with the upside because I believe in XLK in the long run. I believe technology is going to make a strong comeback. So I'm okay with investing in that, but I don't recommend anyone else investing in it. Next stock on the list is Nvidia. So Nvidia pays around the 0.43% dividend yield, so far the lowest of the ones that I've shown. And Nvidia has actually taken quite a tumble recently. However, when you look at it from a long-term perspective, just like Apple, we've come back and we've retested the 200-week moving average. RSI is oversold. This does not look like something that's concerning to me from a long-term perspective. And that's why I love these moving averages so much, is because they provide clarity when it comes to analyzing stock price in a non-biased fashion. So not only did Nvidia come back and retest this 200-week moving average, this is right where the 0.618 retracement sits off of the 2009 lows. So it's nothing sketchy right now. I'm totally comfortable with investing in it. If we start to dip below this moving average, let's say around $100 or so, then it might be time to get a little bit lighter, or then it might be time to be more cautious until we recover that. However, as it stands right now on January 15th, we are above this moving average and the trend looks intact. Next stock on the list is Boeing. So this is actually my only industrial stock. I did want to have some kind of diversification at least, aside from these financial and tech stocks. So Boeing found support off of this 100-week moving average very clearly. And it looks like this move that we've had, where we accelerated really strongly ever since the start of 2016, we've just been consolidating lately. And it finally looks like the trend has caught up to us, which I love to see. Whenever you have a strong move, it makes sense for us to come back and retest the 100-week moving average. In this particular case, the 100-week moving average came back and met Boeing more than halfway. So that's what I like to see. The last few weeks have shown really strong price action, and Boeing looks like it's ready to fly. It's ready to take off. No pun intended. The next stock on the list is Texas Instruments, ticker symbol TXN. So Texas Instruments, I've actually made a video about this one before. I did feel like Texas would go back to the upside after this trading range. But like a lot of consolidating range, it's possible for us to either break up or break down. And so Texas clearly broke down. The market had other plans because this is a round that the entire market was consolidating. So the entire market brought down Texas Instruments with it. We came back after we broke down and we got rejected once again. So after that rejection, it was just like a magnet. It got attracted right to the 100-week moving average. And we've been around this moving average ever since around September. So just kind of hovering around this moving average like a fly to whatever you want to call it. However, from a long-term perspective, Texas still looks pretty strong. And what I love about Texas is it's almost like a blue chip technology stock. Texas Instruments currently pays a 3.2% dividend yield, which is quite massive, and it's rare that you find that with a tech stock. The next stock on the list is JP Morgan. So JP Morgan, also known as Chase, kind of broke below the 100-week moving average recently, very similar to Boeing, because Boeing had a very strong move, and then ever since around 2018, it's just been nothing but sideways consolidation, one slight breakdown before eventually recovering. So Chase, from a long-term perspective, still looks intact, as you guys can see from these moving averages, and nothing much more to add to that, except, however, that JPM does pay a dividend yield of 3.17%, which is awesome. So like I did say in the beginning of the video, I wasn't emphasizing dividend yield, but if it was going to have it, then that's nice. So I definitely like Chase. Next stock on the list is Berkshire Hathaway. So this is BRK.B. I actually don't feel super passionate about this one. I do think that it's going to beat the market on most years. And we did find support here at the 100-week moving average. However, I did make this portfolio for either upside in terms of capital appreciation or some kind of dividend yield. Maybe I would rather have Netflix. That's actually something that I'm contemplating. So I'm not too sure about this one, but either way, it's not a bad place to put your money. I just wish that it either paid a dividend yield or it had more upside in terms of capital appreciation. As you guys can see, ever since 2018, it's been going nothing but sideways. Kind of similar to Bank of America and Boeing, but at least those two pay a dividend yield, and I think Boeing has a little bit more upside than Berkshire in the near-term future. So next stock on the list is Square. So Square is probably on the forefront of the cashless revolution, really similar to PayPal. And Square actually found support here at the 100-week moving average. The last 3 weeks have been very strong. It's possible that we get some kind of pullback or we get some kind of consolidation pretty soon, because as you guys can see, we've gone all the way up from $50 a share to around $65 a share, which is quite a significant increase. That's about 20-something%. So it's quite possible that we get some kind of pullback. However, Square is a high flyer, and I did want to diversify myself in the cashless revolution. And the next stock also needs no introduction, which is also on the forefront of this cashless revolution. So PayPal. So PayPal, once again, like Boeing, didn't really do much from 2018. As you guys can see, we pretty much just went sideways. However, from 2016 all the way up to 2018, it was a very, very strong move, nearly tripled in price. And I do think that this has a lot of upside, just like Boeing, but maybe even more upside. So the next stock I want to talk about is Bank of America. So Bank of America comes with a disclaimer. If you zoom out and you look at the 2008 highs, they currently sit at around $52 a share. So 52 or 55 or even 56 at some point here in 2011, and we currently sit at around 26.55 today. So that's also pretty similar to something like Goldman Sachs. Goldman Sachs, the 52-week high of the 2008 high was here around maybe $240. And currently we sit at under $180. So something kind of off there, with a lot of these other tech stocks. We crushed the 2008 high, and obviously we crushed the 2009 low. And that's kind of what you want to see for something, especially in the long term. So it does come with some caution. And that's actually something that you have to do for all these companies, is zoom out and think about, how do these companies perform in 2008 and 2009, and where are we right now? However, with Bank of America, I still like that it's above both major moving averages. Clearly showed support here at the 200-week, and Bank of America actually pays a dividend yield. So pays a dividend yield around 2.28%. I'm sure with dividend reinvestments, you would have more than made up your money, and you're probably in the green by now if you've been investing since 2008. And that's kind of the same logic that I'm applying here. And I also don't think that Bank of America is going to go away anytime soon. So that's what I like to see with growth stocks. The last stock I'm talking about is Intel. So Intel is actually one of the more underrated tech stocks. I think a lot of people associate this one with slow growth and things like that, which I will somewhat agree. So as you guys can see, since 2008, not only did we not go sideways, but we actually trended down since the high of 2018. So right now we're showing some support off the 100-week moving average. In the past, these moving averages have been support for the most part. I mean, we did dip below the 200-week moving average here in 2013 and here in 2015. And if you just look very briefly at something like Visa, the trend is so much different. We're constantly interacting with these moving averages. So clearly the trend is not as strong for something like Intel. But when you look at the dividend yield, it's nearly 2.54% or 2.5%, sorry. So that's something that I like a lot. And I like it enough for me to invest in this company. So that's going to wrap up my overview with this growth portfolio. Thank you guys if you stuck around to the end. Let me know which of these stocks you guys are interested in purchasing, and I'll definitely link this in the description below so you guys can invest in it if you want. But that's going to be it for today's video. My name is Alex, aka Blood Phantom 81. Thank you for watching, and I'll see you guys in the next one.